Ladies and gentlemen, good day and welcome to Nuvama Wealth Management Limited's Q4 FY24 earnings conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Ashish Kehair, MD and CEO, Nuvama Wealth Management. Thank you, and over to you, sir.
Thank you, Michelle. Good morning. A very warm welcome to each one of you. It's always a pleasure to connect with you all. Thank you for joining us today for our call for the fourth quarter and the full fiscal year 24. Joining me today in the call are Mihir, our Group CFO, Manish, Head of Investor Relations, and we also have SGA, our Investor Relations Advisors. Before we proceed into discussing the business and updates, I just wanted to share an important announcement with all of you. Mihir, who's our Group CFO, will be leaving us and wants to transition into a more advisory and mentoring role, helping many other companies with his decades of experience. I want to thank him on behalf of the entire Nuvama family for the contributions he's made through this important period of transition for us. He came about 6-7 months before we started our demerger process, handheld us through the entire process of demerger listing, and has built a very, very strong foundation of the finance function and of the investor relation function for us to build it from here. On behalf of the directors, on behalf of the entire Nuvama family, I want to wish Mihir all the best as he begins his new chapter of his life. His resignation will be with effect from 14th of May, which is tomorrow. I would also simultaneously like to welcome Bharat Kalsi, who joined us and will take over from Mihir. Bharat is an MBA Finance, Chartered Financial Analyst and a CPA with more than 2 decades of experience across multiple domains like finance, strategy, planning, investor relations and treasury. We look forward to leveraging his experience with some of the scaled and reputed financial services companies in India. He's been with Max Group, Tata AIA Life, and in his previous role, he worked as the CFO and Head of Products and Secretarial Function at Bajaj Allianz Life Insurance. Bharat's appointment as CFO, Group CFO and Head of Strategy for the company comes into effect from 15th of May 24. Coming now to results, we've actually shared our results presentation data book like always. Hope you guys got a chance to look through it over the weekend. We've added some more slides to give more color around our business. I'll briefly summarize on the business outlook and share the progress we've made, some in quarter 4 and some full year, and then hand over to Mihir. He will take you through the numbers and then we can jump into the Q&A. Overall, I think the strong business momentum continues. Our integrated and diversified business model, which we consciously choose to deploy, serves us well. It basically helps us deliver the comprehensive set of solutions to clients and also deliver superior results to our shareholders. And growth trajectory actually continues across both the wealth management segments, the UHNI and mid-market. Our revenues there grew by about 17% YOY. This I'm talking full year. And profits by about 24%. This was after absorbing the material impact of AIF revenue shifting to trail due to the changes in regulations and scaling up capacity significantly in both the segments. Both segments, I think growth cost, as per our calculations, is more than 100-150 basis points. Despite that, I think businesses have delivered this growth, which makes us extremely satisfied. We also benefited, I think, from the significant activity which happened both in primary markets and in secondary markets, which gave a fillip to the capital markets business. And overall revenues for Nuvama grew by about 31%, and with the operating leverage kicking in, the profits came to about 62% full year. This was also a very, very important year for us. Some other milestones which happened. We changed our brand identity in April. We demerged from Edelweiss in May, and in September we got listed. All 3 big milestones, I think, happens once in a lifetime of any company. I'll now quickly get into each of the businesses. Wealth management, both Q4 and full year saw growth. You may see that the PBT number in Q4 is flat Q on Q. That is because of the variable cost catch-up. If we normalize that, both segments have seen growth of around 7 to 15% Q over Q. The assets have now grown to about 2.5 lakh crores. They grew by 36% year on year. And traction, as I said, is there in both the segments, which in our view basically mirrors the entire wealth management story of India. Coming to Nuvama Wealth, I think the demand there continues to grow. In our view, the mid-market continues to present an interesting opportunity because it's growing leaps and bounds, not only in tier 1, but across the entire country. And I think it is the most underserved segment by the incumbents. So it's a combination of both. I think it can absorb number of more players and still continue to grow. We've added about 200 RMs in quarter 3 and quarter 4, and now our strength is about 1100. We will continue to expand capacity next year, and I'll talk about it later. As we scale, because we are getting people now from banks, we've actually invested intensively in our learning and development programs, because most of the people who come in now come from a background where they are trained well on selling traditional products, which is, you can say, deposits, mutual funds, loans, insurance. We want to make them far more skilled in doing multi-products, because client portfolio requires much more than all this. So they continue to do what they do, and they need to get trained on a larger product basket, which is why, and because we are adding in large numbers and we don't want the productivity to go down, I think investment in L&D is extremely essential. In addition to that, I think we've also leveraged significantly on technology. I mentioned in the last quarter that we've launched something called as a One Platform, which can be useful to clients, our relationship people, and external wealth managers. We are now going to launch a portfolio tool because of our whole philosophy of moving the entire relationship team from selling products to offering portfolio solutions to clients. So we've built a very, I think it would be an industry first, leveraging AI and all, built a first portfolio analyzer and recommendation tool, which will be available to RMs across their mobile apps and their desktops and everything. We've leveraged we had acquired a tech company called PickRight about a year back. We leveraged that entire platform to build this solution. This will be rolled out in a beta version now. I think this will achieve 3 things. One, the ability of the relationship person to holistically engage with the client, uniformity of advice, which is a big challenge for the entire industry, and also parallelly, I think it will help increase productivity of people. On the product side, like we've been saying, MPIS, or Managed Products and Investment Solution, continues to remain a focus area. In Q4, our MPIS net flows was actually more than our total net new money in this segment by about 10%. And full year MPIS constitutes 86% of our net new money. It grew by 12% year on year, and it was 30% of the opening assets of MPIS. So about a third of our opening assets we've been able to add this year. Moving on to the ultra high net worth segment, or Nuvama Private, I think the general buoyancy continues. Capital markets doing well, companies doing well, real estate doing well. I think all these become ingredients for ultra high net worth to be continue to grow their wealth. And I think Nuvama Wealth, where mid-market, where there is no ambiguity that it is across India, now we can see even in the ultra high net worth, the concentration is going beyond top tier cities. We've been able to expand into 6 cities beyond tier 1, and I think I don't think there's a demand problem. It is the ability of service providers to reach there, to find the right talent to reach there. The market is out there to be tapped. Capacity, I spoke, we've added about 20% here, and we'll continue to add. The key challenge here obviously remains that how you keep attracting the relationship people. And I think what we realized long back, and we continue to invest in improving our product platform, because the stronger the platform is, your ability to attract clients, relationship people continues. and that is the key differentiator that we will continue to invest in. In terms of clients, we've added about 170 new families in this quarter. And on the product side here, our focus remains ARR revenues. It's not that we don't like transactional revenues. I think it is a key component, and not only in India, globally, because it serves certain components of client portfolio. And the income accounting is unfortunately the way it is, so you can't convert it into ARR. So you have to look at the client wallet and then make your product proposition. On the ARR side, net flows were much faster than overall net flows for fiscal 24. Our overall net flows were about 12%, and ARR net flows were about 21%. No, sorry, overall was about 9%, and ARR net flows was about 21%. Q4, you will see a dip in the NNM, but actually the ARR net flows is about 2,400. So what we lost was some transactional assets, but out of that, major component was of a client who became a custody client. So what we lost from here went into our custody clearing business. If you look at the full year net new money, it's order of magnitude 11,300 crores. About 60% of that comes from ARR assets, which is 26% of the opening ARR AUM. So about a fourth of the opening AUM we've been able to add this year. We mentioned about building offshore. I'm happy to update that we've been able to get our license in principle approval in DIFC. So Dubai or DIFC will be our first go-to market, not Singapore right now, because I think the economics and the market potential there and our product platform suitability, I think all of them come together. It's faster to break even. It's easier to attract talent. And so all in all, I think it's more synergistic with our Indian setup. And we're also looking at offshore not only as a geography for the purpose of tapping clients. I think, as I keep saying, it's also a skill or a very big addition in the platform to serve the domestic clients. Because very soon, if you don't have offshore as a proposition, at least in the ultra-high net worth segment, it will become a handicap for service providers. So I think it's a necessity which we are building and investing. Moving on to asset management, our AUM has now reached about 7,000 crores. Over the last 3-4 months, we continue to stay put on our priorities. Deployment in private markets has been a key priority, and we focused on that. We did not initiate a fundraise in the last full year. We will now start a fundraise in crossover, which is our private equity strategy, both in offshore and in onshore. We are working with a placement agent in the offshore market, which works with the family offices in the Middle East. So you will see some activity going in the next 2-3 quarters. Public markets, our AUMs now stands at about 2,100. It grew by 155% over the last 1 year. In the last quarter also, about net new money of 500 crores in asset management, out of which 70% came into public markets. And commercial real estate is now launched. We will scale it in the next 3 to 4 quarters and take it to the desired level which we initially said. Asset services and core capital markets, which is institutional and equities and investment bank, continues to see exceptional performance. Q4 stabilized though, I would say, but on a full year basis, I think we saw a massive expansion. I think the fee pool in investment banking and institutional equities, in our view, expanded by about 40 to 50% this year. And we also saw a jump of our market share, especially in institutional equities, by about 20%. Asset services, I've mentioned previously that we have 2 client segments of our choice. One, FPIs, in which we deal with systematic quant funds and HFTs, and in domestic, we work with PMSs and AIFs. In both these chosen client segments, our market share last year was about 20%. I think that's it from my side in terms of an update of what happened briefly in the last quarter and full year. I would now request Mihi to give you an overview of the specific numbers across each business, and then we can go into the question and answer section. Thank you.
Thank you, Ashish, and warm welcome to all the participants on this call. At the outset, I want to thank Ashish, Nuvama, my senior leadership team at Nuvama, and my team and colleagues at Nuvama for this opportunity, and Ashish, especially to you for your words of appreciation on this call. I also want to thank you all for the insightful interactions that we have had on these calls and also on one-on-one meets that we have had over time. I wish you all the very, very best. With this, I come to the specifics of our performance for Q4 and FY24. For us, the FY24 was a buoyant year at Nuvama. We saw a well-rounded performance and healthy growth in operating and financial parameters across all the three businesses. Coming to our businesses, and AUM first, our aggregate client assets stood at rupees 3,45,957 crore as at end of FY24, which then grew by 50% year-on-year. Of this, client assets under wealth management business, constituting Nuvama Wealth and Nuvama Private, stood at rupees 2,47,835 crore and grew by 36% year-on-year. Nuvama Wealth client assets stood at rupees 77,930 crore as at end of FY24 and grew by 48% year-on-year. MPIS assets stood at rupees 3,018 crore as at the end of FY24 and grew by 39% year-on-year. In Nuvama Private, our client assets stood at rupees 1,69,904 crore at FY24 end and grew by 31% year-on-year. Our ARR assets within this Nuvama Private grew at 31% year-on-year to rupees 33,421 crore as at FY24 end. AUM of our asset management business stood at rupees 6,967 crore at the end of FY24 and grew by 25% year-on-year. We witnessed strong flows in public market strategies in FY24. Our closing AUM stood at 2,070 crore in this category at the end of FY24, and this grew by 155% year-on-year basis. Client assets under custody and clearing assets stood at 91,156 crore at FY24 end and reported a growth of 109% year-on-year. On our revenues, aggregate revenues for Q4 25 were rupees 596 crore and grew by 35% year-on-year. Our full year aggregate revenues for FY24 grew by 31% year-on-year to rupees 2,063 crore. Of this, total revenues from wealth management business grew by 16% year-on-year to rupees 330 crore in Q4 FY24 and by 17% to rupees 1188 crore during FY24. Within wealth management, Nuvama Wealth clocked revenues of rupees 183 crore for Q4 FY24, a YOY growth of 6%. Revenues for FY24 were rupees 669 crore and grew by 16% year-on-year, driven by our focus on MPIS. Overall retentions were approximately 1% per annum in line with the previous quarters. Nuvama Private recorded revenue of 147 crore for Q4 FY24, a YOY growth of 32%, and revenues for FY24 were rupees 519 crore, grew by 18% year-on-year. Of this, ARR revenues for FY24 were rupees 297 crore and grew by 23% YOY. This constituted 57% of total revenue in FY24. Our asset management revenues, ex-carry, stood at 12 crore in Q4 and grew by 27% year-on-year, and rupees 49 crore in FY24, which grew by 34% year-on-year. Our capital markets revenues stood at rupees 248 crore in Q4 and grew by 71%. Our revenues for FY24 in capital market segment were 805 crore and grew by 64% year-on-year. This reflected the strength of our franchise amidst strong capital market activities. Now on to costs. Our total cost for Q4 FY24 stood at rupees 358 crore and grew by 25% year-on-year. For FY24, our aggregate costs were rupees 1,279 crore and grew by 18% year-on-year. Of this, staff costs stood at rupees 252 crore in Q4 and grew by 23% year-on-year. And staff costs for FY24 rupees 906 crore for the full year of FY24, a growth of 19% year-on-year. Our operating expenses stood at rupees 106 crore in Q4 and grew by 31% year-on-year, and rupees 373 crore in FY24, which grew by 14% year-on-year. Our overall cost to income ratio stood at at 62% for full FY24, down approximately 700 bits year-on-year basis. On to profitability. Our operating PAT for Q4 stood at rupees 181 crore and grew by 57% year-on-year. Our operating PAT for FY24 was rupees 597 crore, which grew by 62% over FY23. Our ROE for FY24 stood at 23.6%, up by 5.8% over FY23. With this, I now hand over to the moderator for Q&A session.
Thank you very much, sir. We will now begin the question and answer session. Anyone who wishes to ask questions may press star and one on their touchtone phone. If you wish to withdraw yourself from the question queue, you may press star and two. Participants are requested to use only handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. You may please press star and one to ask questions. The first question is from the line of Prayesh Jain from Motilal Oswal. Please go ahead.
Hi, good morning, everyone. So firstly, congratulations, decent set of numbers. Firstly, if you look at your cost to income ratio, particularly if I look at it in Nuvama Wealth, it has kind of, while for the full year it's down to 65%, but if I look at the last couple of quarters, it's been higher at 66 and 68%. How should we think about this from FY25 perspective? And what is your, in terms of RM count addition, what are your plans for Nuvama Wealth in particular with respect to, RM addition? What you would have done for FY24 as well as what are the plans for FY25? That would be my first question.
Morning, Prayesh. So, if you look at the cost income for Nuvama Wealth for Q3, Q4, and if you look at our hiring, most of our hiring is actually back-ended this year. In fact, till September, the number of RMs were either flat or net negative. Most of our hiring has happened in Q3, and so the full impact of the cost comes in Q4. That is number one. And there is, when I was giving my opening remarks, I made a mention of the variable cost. We've still not perfected our variable cost estimation, and Q4 was still again a catch-up. If you see, our Q4 revenue is almost about 27% for the year, but our variable cost was 32. So if I take that impact out, then actually the cost income for Q4 falls back to 65%. Okay. And maybe Q1, Q2 will inch up slightly higher. Now next year, see, for this business, what will now happen is that what you've hired now will start producing maybe from 3-4 months from now. So their cost actually came now, but their revenues will start coming later. In this business now, the whole game of cost income is based on how much you will hire in a year and whether it will be front-ended or back-ended. Now this year it was back-ended and about 220 RMs. Next year, if we stick to the same, the cost income should actually fall by 100 basis points. However, if we choose to hire more and if we front-end the hiring, the cost income may actually remain here or may slightly go up. But then year after and the year after, we plan to hire lesser. So I will be more comfortable in giving you a 3-year trajectory. From a 3-year perspective, we want to add about 800 people, 3-year perspective. Now the spreading could either be equal or slightly more in FY25 depending on how the markets are. But at the end of 3 years, our target is 60% and that is on track.
Perfect. Second is on the new money, whether we talk about, from an overall perspective, how do you see new money flowing into the next year? For Nuvama Wealth, it is, from 5,400 odd crores, we've gone to 5,800 odd crores. And even in terms of, Nuvama Private, we've seen kind of, a moderate kind of a growth from 10,000 odd crores in ARR and transaction assets to 11,000 odd crores. How do you see, net new money, and what are the kind of drivers we should look at from FY24? One is obviously the RM count addition that adds to it. But from a 2 to 3 year perspective, how do you see, the net new money kind of flowing?
So friends, broadly, if I look at historically, and I have seen this year over year, and if you do this computation, typically your net new money which comes in is about anywhere between 10 to 12% of your opening assets.
Okay.
Given the combination of assets, and then you add the compounding which happens on the assets, which is why I keep saying that 18 to 20% AUM growth is what you can aspire. Some years will be more, some years will be lesser. Like last year was lesser because of the mark to market was lesser. This year the mark to market is higher, so the growth is higher. Having said that, in both these, if you look at the growth in, let's say, net new money, the way we are targeting MPIS as a focus area, that has grown by more than, I think, more than 30% of the opening AUA. And in Nuvama Private, ARR has grown by more than 26% of the opening AUA of that asset class. So blended basis 10 to 12%, but focus areas should be 20-25% plus.
Got that. I have just two more questions. One is retention on average ARR earning assets has been down in Nuvama Private. Is this because of product mix or anything particular that we have to look at?
No, this is basically product mix. In Q4, our focus was more on building PMS type assets. See, the products basically are essentially PMS, AIF, Cat 3, Cat 2, there is a minor difference, MF. These are largely the products which will generate ARR. Except Cat 2 AIF, everything else is actually equal because everything you just annualize the revenue and you earn. Cat 2 is the only one where about 25-30% of your lifetime commission comes in the quarter of sale. So in any quarter where the product mix will change slightly up or down, you may see a 5-6 basis points up and down happening.
Okay. And my last question is on Nuvama Asset, where you have an M2M negative in this quarter. What is that pertaining to? And also in terms of costs, it's jumped sequentially, substantially. It's just because of variable pay, or is that any hiring that is coming?
I'll answer the cost question first. There was a one-off cost of 10 crores, which was on our JV setup and all. So if you remove that, actually the quarter cost is about 16 crores. And if you normalize the variable, then it should be 18 and quarter 3 should be about 17. So 17-18 crores is the run rate. It will remain at that level. The increase of salary, basically the regular increase of salary and manpower addition, whatever happens next year, that will be the jump. Otherwise, there is no BAU cost jump that has happened. The M2M impact is in our crossover funds. There were a couple of assets which were digital assets where we have done a revaluation and marked them down.
Got that. Thank you so much and all the best.
Thank you.
Thank you. Ladies and gentlemen, in order to ensure that the management will be able to address questions from all the participants in the conference, kindly limit your questions to 2 or 3 per participant. Should you have a follow-up question, please rejoin the queue. Thank you. The next question is from the line of Abhijit Sakhare from Kotak Securities. Please go ahead.
Hi, good morning, everyone. The first one is a data question for both wealth and private division. Could you give us a split of asset mix across, equity, listed, unlisted, and fixed income?
I think direct equity will be around 40%, and fixed income maybe another 15-20, and balance will be managed products. Almost for both similar.
The mix is similar across both divisions?
Almost similar. Not too much difference. We can, I think this is what I remember offhand. Correct.
And second is, if you could, just mention 2-3 action points to improve productivity and operating leverage over next 1 or 2 years.
So operating leverage clearly, like in the past 4-5 years, what is happening now is that the major cost addition is happening only in the sales capacity, because your platform, your infrastructure, technology, everything is almost there. The delta cost will be negligible. And when you add sales capacity, typically you reach the productivity keeps increasing year on year for the new sales capacity.